Hello everyone, I am Jadeley Templado, and I will be reading my answers for assignment number 3, National Income Assignment. So first question, define the following. A. GDP, or Gross Domestic Product. Gross domestic product is the standard measure of the value added created through the production of goods and services in a country during a certain period. As such, it also measures the income earned from that production or the total amount spent on final goods and services or less import or minus the imports. Next, letter B, GNP. Gross national product is the total market value of the final goods and services produced by a nation's economy during a specific period of time, computed before allowance is made for the depreciation or consumption of capital used in the process of production. C. Exports refers to a product or services produced in a country but sold to a buyer abroad. D. Imports is a good or service bought in one country that was produced in another. Imports and exports are the components of international trade. If the value of the country's imports exceeds the value of its exports, the country has a negative balance of trade, also known as trade deficit. And lastly is the net exports. Net exports are the total value of nations' exported goods and services that exceeds the total of its imported goods and services. Next question, number 2. Differentiate GDP and GNP and explain thoroughly the difference and give example. So, gross domestic product or GNP, on the other hand, measures the total economic output produced by a country's residents, whether they are located within the country's borders or abroad. It takes into account the income earned by a country's citizens and businesses from both domestic and foreign sources. GNP includes the GDP of the country plus the net income from abroad. So this net income from abroad can be either the earnings that domestic residents and businesses make from their foreign investments minus the income earned by foreign residents and businesses from their investments within the country. So, example. Imagine country A and country B have identical GDPs of $1 trillion each. However, the composition of these economies is different, leading to variations in their GNP figures. So, country A, this country has a high level of foreign investments. Many of its citizens and businesses have invested in foreign companies and properties, and they earn a significant amount of income from these foreign investments. However, there are also foreign individuals and companies operating within its borders earning income from their activities in the country. So GDP of country A equals to $1 trillion. So income earned by country A's residents from foreign investments is $300 billion. Income earned by foreign residents and businesses within country A is $200 billion. And GNP of the country A equals GDP plus income earned by residents from abroad minus income earned by foreign residents within the country. So GNP of the country A is equals to $1 trillion plus $300 billion minus $200 billion. So 300 billion minus 200 billion is 100 billion. Plus 1 trillion, we have $1.1 trillion. So country B, this country has limited foreign investments. Its citizens and businesses primarily earn their income domestically, and there are fewer foreign entities operating within its borders. So GDP of country B is $1 trillion, and its income earned by country's B's residents from foreign investments is $50 billion. Income earned by foreign residents and businesses within country B is $30 billion. So the formula GNP of a country B is equals to GDP plus income earned by residents from abroad minus income earned from foreign residents within the country. So GNP of the country B is equals to $1 trillion plus $50 billion minus $30 billion. So we have $1.02 trillion. So in the next question, differentiate exports and imports and net export. Explain thoroughly the difference and give example. So exports refer to goods and services produced within a country's borders and sold to foreign consumers or businesses. These can include physical goods like automobiles, electronics, and agricultural products, as well as services like consulting, tourism, or software development. Exports are an important source of revenue for a country and can contribute to economic growth. So example of exports is suppose country A produces cars and exports 100,000 cars to country B. Now these export cars are considered part of country's A exports. So in imports represents goods and services that are produced in foreign countries and purchased by consumers, businesses, or the government within a specific country. So imports are items that are brought into a country from abroad. So they can include items such as machinery, oil, clothing, and various consumer goods. So example of imports. If country A imports 50,000 televisions from country C, these televisions are considered part of country's A imports. So next is that net exports. So net exports, also known as the trade balance, is the difference between a country's total exports and its total imports. So it reflects whether a country's exports more goods and services than it imports, or imports more than it exports. So net exports can be either positive or negative, and they have a significant impact to a country's overall economic health. So formula for the net exports is net exports is equals to total exports minus total imports. So example of the net exports. Let's say that in a given year, country A exports goods and services worth $200 million to $1 billion to other countries, and imports goods and services worth $150 billion. So net exports is equals to $200 billion minus $150 billion is equals to $50 billion. So in this case, country A has a positive net export balance of $50 billion, indicating that it exports more than it imports. So this is a trade surplus, and it can have positive effect on a country's economy, such as increased economic growth and job creation. So in number 4, what are the methods in computing GDP? Write the formula for each method. So I will just read it because it's a video. So I'll just discuss it here. So in production approach, so there are three approaches. The production approach first, also known as the value added method, calculates the GDP by summing the value added at each stage of production. It focuses on the value added to goods and services as they pass through various stages of production. So the formula of this is GDP equals to value of output at market prices minus value of intermediate consumption. So the value of output at market prices are the total value of all goods and services produced in the economy at their market prices, while the value of intermediate consumption is the value of goods and services used as inputs in the production process. So next approach is the income approach. So the income approach calculates GDP by summing all incomes generated within the country during a specific period of time. So this includes wages, salaries, profits, rents, and taxes minus subsidies. So the formula of income approach is GDP is equals to compensation of employees plus gross operating surplus plus gross mixed income plus taxes on production and imports minus subsidies. So compensation of employees, for example, are those wages, salaries, and benefits paid to workers. Examples of gross operating surplus are those profits earned by the business. Examples of gross mixed income are income of self-employed individuals and unincorporated businesses. Taxes and production and imports. Examples are taxes collected from the production and importation of goods and services. And subsidies are those payments to support production or reduce production cost. So lastly, we have the expenditure approach. So expenditure approach calculates GDP by summing all expenditures in the economy, including consumption, investment, government spending, and net exports. So net exports minus the imports. So formula for this is GDP is equals to consumption plus investment plus government spending plus exports minus imports. So the government the consumption are those expenditures by households on goods and services. Investments are those expenditures by businesses on capital goods and changes in inventory, while government spending are those expenditure by the government on public goods and services, like road widening, So exports, sales of domestic goods and services to foreign markets. And the imports, purchases from foreign goods and services from international markets. So for the last question, state examples of each category, subcategories if from main category, in the formula in computing GDP approaches. So in production approach, we have production of automobiles, manufacturing of clothing, software development services, agricultural output, value of intermediate so for the value of intermediate consumption, we have purchase of raw materials for car manufacturing, energy costs for clothing production, fertilizers and pesticides for agriculture. And for income approach, we have the compensation of employees, which are the wages and salaries, as what I've said earlier. Bonuses paid to corporate employees, benefits such as health insurance and retirement contributions. We also have the gross operating surplus, which are those profits earned by the technology company, returns on investments for real estate firm, earnings from a chain restaurant. And we have the gross mixed income, which are those income of self-employed consultant, earnings of small-scale farmer, sales income of independent contractor. We also have the taxes on production and imports. So we have sales tax collected on goods and services, and excess taxes on alcohol and tobacco, the value added taxes, import duties on foreign goods. We also have the subsidies, which are those government subsidies to support agriculture, subsidies to promote renewable energy production, export subsidies to boost overseas sales of specific products. And for the expenditure approach, we have the consumption, the C, purchase of a new car, monthly grocery expenses, and restaurant meals. We also have the investment, which are those construction of a new office building, increase in business inventories, research and development expenditure. And we have the government spending, which are those funding for public schools, defense spending on military equipment, and public transportation system maintenance. And we have the exports, which are those export of electronic to foreign countries, intermediate sales of agricultural products, software, exports to overseas markets. And lastly, we have the imports, which are those import of oil for domestic energy production, imported automobiles from foreign manufacturers, and lastly, purchase of foreign electronics and consumer goods. So that would be all for my answers in A3 National Income Assignment. Once again, I am Jadeley B. Templado, and thank you for listening.